Hello viewers, in this video we'll be going over the S&P 500 ETF ticker symbol SPY. In this video we'll be going over the day-by-day probability model, how we find the models, and the day-by-day forecast for the S&P 500. So back to the technical analysis. Today we are down 1.3%. On the 1 hour chart, we start to see us reaching the oversold RSI, the 1 hour MACDs approaching negative. On the 4 hour chart, we see a divergence in shape in the 4 hour MACD, and we're quite close to positive MACD. And on the daily chart, we are starting to see a divergence between the 9-day moving average and the 18-day moving average, these purple and blue line. And we made a complete reversal. What we saw of yesterday in the morning, we saw a large spike down, and towards the end of the day we managed to close up green. However, it's reversed today. We started higher a bit and then we headed lower throughout the day. So if we were to continue down lower, I do see a possible support on the 50-day moving average, this yellow line, and that also coincides with the prices back in, I would say, back in late December or December 30th, past resistance, since we're above that price level, that now act as our support. And that is around the price of $321.16. So that is our first immediate support if we manage to close down lower. As for resistance, I do see the next resistance being the gap between January 24th and January 27th, around the range of $328.70. We do have that gap down. We may manage to reverse, hit that gap, and possibly head down lower overall. So if we do manage to hit that resistance, that price movement is roughly around 1.7% to the upside, and to the downside is around 70 basis points to the downside. So back to the day-by-day probability model. As the day progresses, we do have a slight favor to the upside. We have a 52% chance of the S&P 500 climbing between 0 to 3%, and a 4% with, on the extreme case, 3 to 5% chance higher. On the other hand, we have a 39% chance of the S&P 500 heading lower, 0 to negative 2.8%, again with 39% chance, and 4% chance on the extreme case. We may fall between negative 2 to negative 5%. So again, this model is now available in the link below, so do check it out. So this model will go day by day, where the S&P 500 will head to in the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to April 14th to July 10th, 2014. So let me point out why these two charts are similar. So what we have on the current trend, we start off averaging above the middle Bollinger Band for several weeks, and afterwards we see it revert back to the mean to touch the middle Bollinger Band at this instance. So if we mark that, so we see a tight concentration around the middle Bollinger Band in the current trend. In the trend in question, we start to see a similar pattern as well. We average above the middle Bollinger Band for several weeks, and we see it, in this case, slowly revert back to the middle Bollinger Band on the trend in question. So we have those points. We have about 1, 2 points. We also have 1 and 2 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was April 14th to July 10th, 2014. Back then, the S&P 500 was up around 49 basis points. So we may see a possible reversal to the upside for the S&P 500. However, it is a very small reversal. So back to the day-by-day probability model that coincides with between 0 to 2% chance higher with a 52% chance. And again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.